This is Akashvani. In the program Spotlight, now we bring to you a discussion on Reserve Bank of India's bi-monthly monetary policy review. The participants are Anil Padmanabhan, economic analyst, and Lalima Aneja Dang, anchor.
Well, following the interim budget by Finance Minister Ms. Nirmala Sitharaman on the 1st of February 2024, the February monetary policy meet by RBI holds even more significance as it is the final one for the current financial year. RBI conducts 6 bi-monthly meetings in a financial year to deliberate upon interest rates, money supply and inflation outlook. We are now joined by economic analyst Mr. Anil Padmanabhan to discuss more on the RBI monetary policy. Welcome, Mr. Padmanabhan, to Akashvani studio.
Thank you for having me, Lalima.
Anilji, the repo rate is the rate of interest at which the RBI lends to other banks. Most of us know that. This was last revised in 2023 to 6.5% from 6.25%. But this time, it has been kept unchanged at 6.5%. How does it affect the economy? Does it mean that easier for people who have taken loans?
Before I explain that, let me just give a bit of background. The repo rate is an outcome of a certain macroeconomic circumstance. And this has been forced upon the country because of rising inflation. And which is why the Reserve Bank increased interest rates pretty rapidly. And it's at 6.5. Now, yes, it has made loans costlier. It has definitely raised the cost of investment. And that is exactly the idea. The idea is that because earlier excess demand was chasing fewer goods. So they wanted to correct that balance by demand does shrink. Right. So now that hopefully there'll be a convergence of demand and supply, and this runaway rise in inflation that we saw previously it has already peaked out. So the general expectation is that it'll move closer to the comfort level that the Reserve Bank wants.
Talking about inflation, it's on a downward trajectory, the RBI governor said. The headline inflation has moderated to 5.5% in April-December 2023 from 6.7% in the financial year 23. Headline CPI inflation for financial year 24 is at 5.4%, with the projection of financial year 24 fourth quarter, the current quarter, at 4.5%. How do you describe these figures for the common man?
There are two metrics for inflation which all of us should be familiar with. The economists call it core inflation, which is nothing but minus fuel. The general inflation, less fuel. Now, that has been falling very sharply. And it's, I think, about 4.4% at this point of time. But food inflation is not moderated at all. It is actually been climbing. And more importantly, it is volatile. So right now, it is like 8.7% in December. It was 6.3% in October. So it has accelerated. But again, this has not happened because of an across-the-board increase of all food items. So it has gone up because of vegetables. Previously, it was tomatoes, and now there are other vegetables. So which is a point of concern that food prices are not steady at all. They're pretty volatile, and they're moving up and down. But the core inflation is falling, which is what impacts industry, which is what impacts everyone else. So there's good news and bad news. The bad news is food inflation, and the Reserve Bank of India flagged it today. And the governor was very particular. He said that this volatility concerns us. So till such time we are comfortable with the overall inflation, particularly food inflation, we will not proceed to the next phase of interest rates, whether it is to stay neutral or to cut.
When we talk of food inflation, does it majorly mean rabi crops, and also the fact that agriculture is hugely dependent on the climate conditions?
The governor particularly said today that their data is showing, which is of course Government of India data, that rabi sowing, despite a bad northeast monsoon, not bad, a subpar northeast monsoon, is 5% higher. So which is what makes them hopeful that there is an agri revival. Then, more importantly, there is a subtext to our overall agriculture story. Because when we look at agriculture, we are all mesmerized by the headlines of food grains. But the nature of Indian agriculture in the last 15 years has fundamentally changed. Because food grains is no longer the dominant share. It is now horticulture. And horticulture in 22-23, which is basically fruits and vegetables that we are talking about, has hit a record of 355.3 million tons, which is even higher than the final estimate of 21-22. Plus, you have record fish production. This even was news to me. And India is now the third largest producer of fish in the world. So you see the nature of agri has changed. And that is also has consequences for the economy in terms of demand, employment, because the food processing, value added, those segments are now going to dominate while we go forward, which is why it's interesting to see that one of the sectors which is seeing investments is food processing.
Yes, for a long time when we thought of food, we only thought of those two grains, rice and wheat, because of the green revolution. But thankfully, we have diversified. And to add to what you said, even millets have now come to the forefront, which is a very good news for the farmers and for the consumers. Well, moving on, that brings me to the next question. What about rural demand? That continues to gather pace and urban consumption remains strong, observed the RBI meeting. And do you think this is because of the fact that we are on very strong fundamentals? Our economics is strong. We also have a very strong system of saving rather than being on credit traditionally. All that has helped us see this beautiful picture of a good rural demand and urban demand.
In the case of rural demand, it's been struggling for a while. But what the Reserve Bank of India has been saying consistently at that from December, that according to them, rural demand is actually picking up. And they identify three reasons. One, they say the demand for Manrega, which is basically the employment guarantee scheme. Now, the employment guarantee scheme is when I demand the job. It is not that the job is there, but when I demand the job, I'll be given the job. And I demand the job because my domestic economic situation is inclement and I need to support it with extra income, which is what Manrega is about.
Right.
Now, Manrega is declining the demand, which is one reason they have said. Second, they are saying that the decision by the union government to extend the free food grain program for another 5 years to 80 crore people is also helped in providing the base to the demand, basically demand in rural economy. And finally, of course, what I just discussed, the agriculture situation, while it hasn't grown well at all in the current fiscal year, which is 23-24, but it has definitely, according to them, it is going to pick up in the next crops year because, like I said, the Rabi sowing is higher, 5% higher than last year, despite uneven monsoon. So these three factors they have pulled together to say that rural demand is actually picking up, and which is fantastic news for a range of industry, particularly FMCG, the consumer goods companies.
Anilji, when we talk about forex reserves, it's been unprecedented. We've had very good investment. We are now very comfortable at $622.5 billion. Does that mean that we have enough for our infrastructure spent? Not just about the 80 crore people being given free food, it's also about investing hugely in infrastructure, which means ports, airports, highways, world-class railway stations, and so on. So does it increase our confidence in our own economic health system of our country? How would you view that?
The foreign currency reserves are a very important metric to assess the economic health of any country. And 600 plus level of reserves is very healthy. Broadly, the metric to examine the extent of this cushion is the amount of import cover that it will generate. At this level, we are looking at 6 months of imports, so which is a very comfortable situation. That is in the event of some unforeseen crisis, like say a COVID which lasts. Mercifully, that won't happen again, but it's a contingency. Now, you have to contrast this also with our debt situation. So the IMF just came up with their annual review of India, and they found that India's debt to GDP ratio had gone up from post-COVID to something like 88%, but it has now come down to 80.5%. But that's good news. In a relative sense, this gets more amplified when you compare it with what is happening in the advanced economies. The advanced economies, according to the IMF, the debt to GDP ratio is gone through the roof. It has reached untenable levels like 140, 160, 180%, which at this situation, when interest rates are on the rise, it is a very risky proposition because it can threaten another economic crisis. From nowhere it would come because interest rates are rising. So the cost of servicing this debt will go up and be unable to meet your debt obligation. There could be a default. I mean, I'm not painting a scary picture. I'm just explaining that there is a external circumstance which makes India's situation even better. So if you look at reserves, you look at external, overall debt, external plus internal, you are looking at a pretty comfortable position for India at this point of time.
Let's talk about another statement which came from the RBI in this meeting, and that is the requirement of KFS, that is the Key Fact Statement, which is now being extended to cover all retail and MSME loans. MSME contributes a lot to our growth, probably 40% plus. Do you think that this is a very important step in streamlining MSME loans?
Any financial system is built on one fundamental foundation, that's trust. And that trust is again determined by the level of transparency. I'm sorry to say, but the transparency in India's financial sector is not above reproach. It's actually in serious doubt. So let's take our personal lives, for example. When we take a loan and we suddenly wish to repay it, then we are given a list of costs that we have to incur, some repayment costs, which we were not aware of. But we are told that it's in the fine print, which we didn't see. What Reserve Bank is saying is that all the costs should be reported directly upfront when you're negotiating the loan with any borrower. So the borrower goes in with eyes open, not eyes half shut, because eyes are half shut not because you're not willing to look, but you don't know where to look. This is complex legalese. It's very difficult for a normal person to go through unless you get a lawyer with you. How many of us can afford a lawyer to get a loan? This is why this transparency is very important, because then it helps in building trust. And if trust is there, then a financial sector rocks. And if it doesn't, and it impacts, we have seen that. We had the bad loan phase in the last decade, and you saw the impact it had on the banks, it had on company balance sheets, on national sentiment. I mean, everything went haywire. So which is why this transparency is very important in reinforcing that. And finally, these are all very important measures if India wants to adopt the rule of law. I mean, they are adopted it, but you want to go up the ladder of rule of law, then these are very important steps which should be non-negotiable.
So, Anilji, can we say that the confidence that an ordinary Indian has today in the economic health of the country, seeing that the RBI is also very satisfied about the exchange rate of Indian rupee, which has been fairly stable, can we say that the Finance Ministry and the RBI, they are in perfect synergy, and that has brought about the stability that we see in our country?
In my 3 decades of covering economic journalism, I have rarely seen such synergy between the Reserve Bank of India and the Finance Ministry. And it is a welcome measure because it's not that a Reserve Bank is kowtowing to the North Bloc. They are maintaining their independence, but they're coordinating in a very transparent way. This was most manifest during COVID. The way they came together to salvage the financial sector and the economic sector. One simple example I'll share, which is on giving the guarantee to credit guarantees that the Reserve Bank of India gave so that money continued to flow to the commercial sector in India to companies because they did not have the wherewithal to go out and borrow. But because the guarantees were there, credit flow was not impacted. That was very, very important to maintain the economic fabric of India. So that is one very good example about this coordination between the two. Last week, Finance Minister Nirmala Sitharaman announced, contrary to expectations, even a lower fiscal deficit for this fiscal year and committed to the glide path for 4.5% by 25-26 of GDP, the fiscal deficit. That is of huge relief for the Reserve Bank because if the Government of India does not go in with huge borrowings, it will not squeeze liquidity out of the market, which means it'll be easier for the rest of commercial sector to borrow because the central bank will not be coming in with the union government's borrowings. So that commitment, that certitude opens up the space, very important policy space for the Reserve Bank. So which is why their conduct of monetary policy also improves. So whichever way you look, this coordination between the two institutions is very welcome.
Well, on that optimistic note, thank you, Mr. Anil Padmanabhan, for talking to us, for giving your views and reviews on a very important topic about the RBI's monetary policy meeting. Thank you very much, sir.
Thank you for having me, Lalima.
You were listening to a discussion on Reserve Bank of India's bi-monthly monetary policy review. The participants were Anil Padmanabhan, economic analyst, and Lalima Aneja Dang, anchor. This program was produced and presented by the News Services Division of Akashvani. You can listen to it on our mobile app, News on AIR. This program is also available on our YouTube channel, News on AIR Official. You may share your feedback about this program through email at airnsttalks@gmail.com or WhatsApp on 9289094044.